Drop a one in the chat if you can see my screen, guys. Yeah, sure thing. Great. All right. When we last week we had talked and we were like, okay, I'm gonna teach you guys a little bit about demand and supply or the likes like that. So demand and supply. Number one misconception about demand and supply is that people think when you're trying to identify demand and supply zones, you have to identify an area where there was multiple rejections in the market. That's where your demand or your supply zone is at. It's like you say like, oh, we see somebody just be like, this area right here is looking like I just say this, they'll be like this area right here is looking like a good demand zone slash supply zone. They'll say this one is demand because it bounced here and then it went up and then it rejected here and it went down. So they'll be like, oh, this is a good demand zone, this is a good supply zone. But demand and supply zones, number one thing you need to know, it's not about where there's multiple touches in the market. Demand and supply zones are drawn off particular candlestick bodies or candlestick patterns. You don't draw it based off where there's multiple touches. That's number one misconception. You can literally draw your demand zone even before price gets there for the first time and reacts up there. Number two thing, if a demand or a supply zone is broken, it becomes an invalid zone. There's a difference between a demand and supply zone and a support and a resistance zone. You can choose to draw this like, yeah, this is a support zone slash resistance zone because why? In trading, when support is broken, it tends to resistance, and when resistance is broken, it tends to support. That's how it is. But demand and supply, when it's broken, it does not. When demand is broken, it doesn't turn to supply, and when supply is broken, it doesn't turn to demand. If you know the conception about demand and supply from basic economics, it's about demand, they're asking, their suppliers, the sellers are supplying. There is no point where the sellers are becoming the buyers and the buyers are becoming the sellers. It doesn't work like that. One person is constantly selling and one person is constantly buying till the market changes. So when the market goes, if one person is buying in one particular market and one person is selling in one particular market, they both are not doing the same thing in one market. So those are the misconceptions that people have about demand and supply zones. Let me explain that to you guys first of all. So I don't want to hear no one saying that, oh, when this demand zone got broken, it turned to supply zone. No, when a demand zone is broken, me personally, I delete it off my chart. So first thing first, how can you identify a good demand zone or a good supply zone? This is something when I'm saying, I expect you guys to write it down. This is like some notes. I'm not going to be typing it, nothing like that. I'm just going to say it and you put it in your own words. Is everyone following up on me so far? If you're following up on me so far, drop a one in the chat. I'm trying to wrap this up for real, so I can get some rest. I'm not really trying to go back and forth. So I want to make sure everyone is on the same pace with me right now, guys. That's great. That's great. So quality, what I'm about to tell you guys now is the quality of a good demand and supply zone. Number one is the freshness of the zone. In demand and supply, the more it gets touched, the weaker it becomes. Because why? It's like a zone holds a certain amount of orders in the market. Let's just say this is a supply zone. Let's say in this supply zone, there are 200 orders in this zone. The market might react off here and pick 50 orders and sell. So it means there's 150 orders left. The market comes against that supply zone and pick up another 50 order that's left. It means there's left 100 supplies on that zone. The market comes back and pick 100 and sells further down. It means the next time the market is coming, it's most likely to break because why? There are no suppliers to give to the demand. So price will break and look for a new market, a new price level where the supply at for market to push down again based off the supply found on that price level. Does that make sense to you guys? You can drop a one in the chat. Let me know you're following up. It makes sense for you guys. If it doesn't make sense, you can type a question or you can ask for me to unmute you and then you can ask your question. All right, so everyone's following up so far. I love that. All right, so that's another thing when it comes to demand and supply, and then it comes to support and resistance zones. Support and resistance zones are the stronger, the more the touch is, the stronger it shows that that area is because it's being respected multiple times. But of a demand and supply zone, you want that first touch is always a good touch, the second touch is a good touch, and the more it's picking up others, like I said, the weaker it becomes. So me after like three to when it goes 1 to 3 touches, and then when it starts entering the 4 to 5 touch, I'm careful taking a sell or a buy from that area because it become weaker. The next thing is the strength of the move. The strength of the move from the first move when price gets there tell you if that zone is strong or not. So again, based off the same example, let's say for a reason, this is a supply zone here. Price gets back to that zone for the very first time. So depending if price push down this short, it tells you that the zone is a weak zone. It is weak because it was not able to push price far away from the zone. If price gets to that zone and start consolidating on that zone before it sells, it tells you that well, that zone is not strong enough. So that's why it says the strength of the move, the strength of the first move will tell you if that zone is a good zone or it's a bad zone. Now it will not make too much sense to you because you don't understand how a zone is drawn. But when you draw that zone, the first move that comes to that zone, if that first move, you take that trade off there, the sell is not strong enough or the bias is not strong enough to push it outside far away from it, it tells you that zone is weak. So the more it comes there and the moves are short, it tells you that that zone does not hold enough orders to push price to a different level. Does that make sense, guys? Brilliant. Say one more time. Okay. We're talking about the strength of the zone, the strength of the move, sorry, will tell you if the zone is a strong zone or a weak zone. For the very first move that approaches the zone, being demand or supply, in this case means supply, the market approaches supply. It means the market is supposed to sell. If the market sells only by a couple of pips and not too far away from that zone, it tells you that if it sells far away like this, it tells you it's a good zone. But if the market goes ahead and sells only the short, it tells you that it is not a strong zone. If it sells this short and then goes back into that area and sells again, it tells you that this is not a strong zone from just this first touch. Because why? The first touch means it's fresh. The freshness of the zone. Number 1 point was the freshness of the zone. The zone is fresh. That means the very first order should be a good push. Should be a good push. Sometimes the first order will not be a good push, but the second might be a good push, depending that price maybe came back a second time, and then it picked up more orders compared to when they picked it up the first time. It's like, okay, the market was like, let me just test this price level if I like it or not. Price gets back, it's like, okay, yeah, I do like it. I will take more orders, and then it sells even further. So that's why even regardless, you will still want to take your sell from that zone. I'm not saying that because the first sell was not strong means the second sell will not be strong. But in most cases, it will not be. It's just anything could happen, but you could still trade your sell. So the first time it gets there is weak. It could come back the second time and still be weak, but you just have to be mindful that that zone is giving vibes of not being a strong zone. Price will get there. If you buy strong off the very first time, it's a strong zone. Comes back again, you're expecting again another strong push up because the very first push up was a strong one. So initially, we believe that the second one will also be a strong one. When the first one is a weak one, we believe that the second one will also be a weak one, and so on. Makes sense to you, Freddie, now? Bet, bet, bet. All right. The next number 3 point, the time spent at the zone. if price approaches a zone and then it consolidates for a minute before it sells off, that tells you that zone it's not strong as it's supposed to be, or as you want it to be. The time spent at the zone. You want to see price get to that zone and then immediately react of that zone with bearish price action around this area for you to enter for a sell. So if price gets to a zone and consolidates for a minute before pushing, that zone is most likely not to be a strong zone. That first move would have happened, but it means when it comes by the second time, it's most likely to break past that zone. So the time spent at the zone is one of the qualities. Make sense? Great. You know the time range spent by the amount of candlestick at the zone is consolidated on the 1 hour, it consolidates by 5 candlesticks. It means it took 5 hours before it wants to make that move. So you know by the time frame you're looking at it. There's demand and supply on every time frame. So the whatever time frame you're looking at, that candlestick body, if you're looking at the daily, it takes 5 candlesticks, it took 5 days. That's how you know. That. All right, the next quality, which is the last quality, is the stick size of the candlestick size that left the zone. So in the case where the market got there to supply and then wants to sell, and it's like the candlestick formation for the bearish price action, if it's like a solid bearish candlestick, or was it like a weak bearish candlestick with a wick on it, like that tells you if it's a strong zone or not. Like if price gets it, then it's like a nice solid bearish price action. So it's basically the price action that leaves the zone will tell you if it's a good price, it's a good zone, or it's a bad zone. Make sense? The price action that leaves the zone. Price action has to do with things like evening star, morning star, Tuesday top, Tuesday bottoms, all those type of things. Those are the things where you ask yourself, did that one sink in as well? Those are the 5 factors of a good supply or demand zone. Did that make sense, guys? Uh, all right, cool. So now that you guys know this, I want to ask you guys, did you ever know this about demand and supply? Did you ever know these criteria about demand and supply? All right. So the next thing we're going to learn are the different movements when it comes to demand and supply. We have a couple of movements. We have 4 different types of demand and supply situations. 2 of them is continuations and 2 of them are reversal. So to learn about a continuation, we have what is called, why is this thing not giving me my text box? It's not even giving my text box, that's crazy. We have what is called the rally base rally, what is also called RBR. That's rally base rally. Now, this is a continuation pattern to the upside. When the market is moving up, it's called a rally. In the case, the same word, the same Synonym expansion, but in this case, you call it a rally. Rally-based rally. I'll give an example of it. Where's that thing? I just literally pulled out. So a rally-based rally is price literally pushing. This is the example right here. Can I zoom into this thing? Okay. This is the example. Price rally up, it could consolidate. It gives the base, price push back into that base, and then it continues rallying up. So that's called a rally-based rally. And based on the different type of candlestick patterns, that is how you can identify a base. Right now in the market, when it comes to a rally-based rally, based off this candlestick pattern, there's two bases right here. This is the first base, which is for a rally-based rally. This is the second base for a rally-based rally. And I'll explain to you guys why these candlesticks are chosen. But now don't worry about the candlesticks, just worry about knowing what a rally-based rally is. The market rallied up, gave a base, gave one base here, gave another base here. It rallied back up, came back to that base, and then it rallied again. So that's a rally-based rally. Rally came to the base and then rallied back up. That's a rally-based rally example. It's a continuation movement in the market. The next continuation one is a drop-based drop called DBD. Not DDG like the rapper, but DBD. Drop-based drop, also called DBD. And this is the vice versa for a rally-based rally because this is for a downtrend. The market is trending down, you find your base, you draw your base in before the market comes there, and the market reacts off that base for a drop. In this, let me look for a practical situation for a drop-based drop, which would have been this situation right here. This is the base. The market comes to the base, it drops, comes back to the base, had one touch, was not the strongest of touch, came back again the second time, and then price pulled down. So that's a drop-based drop right there. So that's why I say sometimes price will not initially, like the second move might be stronger than the first because he just came back and decided to do a double touch on it, and there's nothing wrong with that. This is still another drop-based drop right here. And when price came, you can draw all of this before price gets there. It gets there and it reacts off it, gives you a nice price action, and it sells to the downside, and it reacts off another base for a bullish momentum to the upside. Price gets into that base and then it break past it. It didn't react off it, it didn't respect it. So this zone, it was respected only one time. So that's why everything is called a potential demand and supply zone. There are criteria when price gets there, you have to see before you enter a trade. Because you identify the demand and supply zone doesn't necessarily mean that you just get in the trade because you were able to identify its demand and supply zone. It means if it gets there, you just sell it. If it gets there, you just buy. No, it has to get there and then you wait for other factors to make you to want to get into that trade. Capiche? Does that make sense to you guys? Are you following up? Bet. So unlike Clara's stuff, this is a drop base. Price gets back to that base and then it drops again. Continuation pattern, drop base drop, just like that. The top is a supply, the bottom is a demand. Top supply, bottom demand. Sometimes people get confused because top is resistance, then bottom is support. But when you catch a base at the top, it's called a supply zone, and at the bottom, it's called a demand. I said I'm coming to that. I'm gonna teach you guys how you identify a base. I'm coming to that part. But now I just want you guys to know the different type of movements. So when I'm identifying that base, it's making more sense. The next ones that we have, so those are the two continuation. The ones for the reversals is called a drop-based rally, also known as DBR. So this is a reversal for a buy. Market could be dropping, then it reverses off for a buy, drop-based rally. It drops, creates a base, and then comes back, and then it rallies up that level. So this is a drop-based rally. You see that? This is a reversal. Market is on the downtrend, drop-based rally. Excuse me. And the next one, is called the rally-based drop, also known as RBD. Market is dropping. Sorry, market is rallying in an uptrend. Gets to a base, then it reverses and drops. Rally, base, drop right here. This is the example right here. Rally up, creates the base, and then it drops. Comes back to that base, react off it, and then it drops. So this is a reversal. Right there, just like that. Those are the practical examples. If you want to take a screenshot of that, then that's cool. Fine. This is like a recording, another recording. I guess some classes are recording. So now we know the 4 different types of demand and supply zones, right? We know the 2 continuations and we know the 2 reversals. But now we know the factors we're looking forward to when it comes to the freshness of the zone, all of that to know a good quality demand and supply zone. And demand and supply zone, whatever time frame you draw that zone on is the time frame that zone is being respected on. So if you draw a demand zone on a 1 hour, for instance, if you draw a demand zone on a 1 hour time frame, and then let's say the candlesticks breaks past that zone on the 30 minutes and then comes back and sells again. So basically it's going to create a wick on the 1 hour, and on the 30 minutes it has broken that zone and closed above it. Because when the candlestick closes above your demand zone or supply zone, it becomes an invalid zone because candlestick is not supposed to close above or below that zone. It depends on what zone it is. So in this case, it's supply zone. So if price closes above the supply zone, it becomes invalid, and if price closes below a demand zone, it becomes invalid. But on the time frame that you're trading on. So if I'm looking at the 1 hour demand zone, I only want to see a 1 hour candlestick close above it. But if a 30 minutes, 5-minute candlestick goes above it and then comes back all the way, it instead rejects instead of closing on the 1 hour, then that zone is still very much valid to me. Make sense, guys? All right. So that is technically another rule you want to add into the 5 rules I gave to you. Just how to maintain how to validate like if the zone is still valid or not. Well, this guy said he's pulling up. What other people are you guys pulling up or no? So number 1, drawing a demand or supply zone based off a pin bar formation. A pin bar is basically this. It could be a bullish or a bearish pin bar. It has a little body, then has a long wick, just like that. A pin bar formation. It could be bullish or bearish. You draw it the same. So in this case, you're taking the entire wick and body to draw your demand zone or your supply zone, depending where it is on the trend. In this case, price is on a downtrend. In this case, price on the downtrend, price gets there like this, creates a pin bar, price goes and then comes back into that zone. So now this is what a drop base rally move. So it means when price comes back into that area, we expect price to go up instead. Doesn't mean that because it just gets there means we're just supposed to off the jump sell of that level. I mean buy of that level, but we want to see bullish price action. So in this case now, what is bullish price action? You want to see anything of a even of a morning star or Twizzler bottom or a lower time frame break of structure. A practical example, this is a sell practical example, but I'll give you guys, this is a buy practical example, but I'll give you guys a sell. In this situation right here, we have a pin bar right here. So you could draw your pin bar and price gets to that pin bar for the very first time. The market is selling. Price gets to that pin bar the very first time. You would have probably, it gets to that pin bar the very first time. Though right here is still another demand zone in this area, but you validated up this first demand zone. You're waiting to see that, okay, let me see price drop and then comes back into the area. Let me take a short. Price is moving. You're waiting to see whenever price comes there. So you see you're drawing your zone even before price gets there. It's unlike supply and resistance where you draw because price has been there before. So you're drawing your zone before price gets there. You see that? You're like, all right, I'm waiting on my zone. Price gets there. You're just waiting. Price get in there the first time. Because price got in here the first time doesn't necessarily mean that you just off the jump take your sell. You have to wait for bearish price action to take your sell. We're waiting on bearish price action. And that's a nice bearish price action because why? This is basically a bearish engulfing of a demand zone. That's pretty much solid. We're waiting on the closure and price did what? Price closed lower than this bullish candlestick open. So that is a good entry for a short position. As price closed, you're entering that trade. Enter stop loss above that level. The one thing about demand and supply now is anything is about a factor about this trade at the moment is that this area right here is also a supply zone based off of the candlestick body that I'll teach you guys about. But now this is a very keen area to want to take your trade off it because you can see that there was multiple rejections within that area, but you can tell that this area is not a strong area because when price pushed up, it barely went anywhere. So you can tell yourself that this zone right here is a weak zone because after 1-2 movements, the price did not go anywhere. So you see how you're using those factors of, because some people will be like, oh, I'm identifying too many supply demand zones around price. It's just so close together. I don't know which one to trade off from. You know that they are like getting peer pressure. But now, because you know the qualities of a good demand and supply zone, you can identify that, okay, now that demand zone there is a weak demand zone. So price will pick up orders from that supply zone and will be able to break past that demand zone. So it means there's more supplies than demand. Does that make sense? I want you guys to answer in the chat so I know I'm talking to people. I'm not just like, I'm not just going without you guys. All right, great. So let's watch our price, please. Let's say you take your shot from that position right there. We have our factors and let's see how price goes. Why doesn't have 3x? I don't want to go that fast. Oh, I stopped revaluing now. I'm tripping. All right, price goes ahead and is going back into that zone. And what happens to that zone? It has another rejection into that zone. Price was able to push past and break that supply zone right there. I mean that demand zone right there, my bad. When price did that, price now has switched market structure entirely. So you're looking at price was pushing up. it would have been given higher highs and higher lows. The price now has switched structure as well, gotten back into that zone, reacted off that zone, and now it has created a new lower high. It's potentially created a new lower high. Right there, the bearish price action is not even good for you to want to enter a second trade. You need to wait till price goes lower than this white line, and then you enter for like another entry. Again, price goes back into that same area. I might just put it 3x. I think that 1x is kind of slow. All right, that's it. It keeps pushing, playing around and stuff. And it keeps going down and down. And then from there, you see, if you like, you see how price has this different supply zone down here, which is this pin bar. But usually it's supposed to be a bullish pin bar. This is a bearish pin bar. On the top is a bearish pin bar. On the bottom is supposed to be a bullish pin bar. But it's just a pin bar. So like that's why this zone, like you will see how it's gonna react off it. Like see how it's taking its time to react off it. But it's still kind of respected it. It's always better to have a bullish pin bar. It's like that one is more quality. That's a more quality setup. So of that area right there, price now rejected off this supply zone and then pushed up. So you see the same factor that I gave you for your sell, gave you for your buy. The same pin bars. Another pin bar again, just down here for you to have used it. If price broke this pin bar and then validate that buy from there, you have a second pin bar right there. Second pin bar right there. And of the buy price action, these three candlesticks was the thing that initiated this buy. Market came down here. Market started slowing down on the sell pressure. So market is slowing down on the sell pressure on the demand level. That's telling you that the market doesn't have the ability to break past that level. So that sell that you were in, you should start leaving that sell. The moment market picked up, right? Market picked up from this area. You see, there was indecision, then finally a bullish decision. How far did this bullish decision go? It went far enough to go at equal levels on the open of this bearish candlestick. Price got in there, pulled back on lower time frame and broke past it. And then it continued to the upside. So you see how this trade went from a nice sell position to now another nice buy position. So we have left this trade for the buy, for the sell, and got it in for the buy. That's why when I tell my students, your entry is your exit, and your exit is your entry. You're in a bearish trade, you're selling, and if a bullish trade start presents itself, the reason for you to enter for a buy should be the reason for you to exit your sell. That's the difficulties people be having in trading. They be like, they don't know how far the move will go because why? They're like selfish. Selfishness will lead to stupidity because you get into the trade, you want to catch a 1:4, a 1:5. It's not your father fucking living room. You feel me? It's not your dad's parlor. You cannot tell the market what to do. If you can identify where the market is about to potentially reject off from, you'll get out of your trade with your profit. You feel me? So people will be like, oh, I think I know the trade. Like I had this one student one time, but now he's doing pretty good because he stopped trading as if the forex market was his dad's living room. You feel me? He will get there, he wants to trade. He's like, oh, I want to catch 1:10 now. If this market does not give me this money, I'm not leaving this trade. I'm like, bro, this is not your dad's living room. You get in, even the market gives you 1:1, you're leaving that trade because that's all the market had to offer to you. That's all that the move had to offer. I don't trade personally with TPs because I read the volume. I keep on reading how price is moving. The moment price now starts giving me those reasons to leave those trades, I will leave because why? My entry is my exit is my entry. So of our pin bar formation for our demand or supply zone, we have already seen a very good practical example right here. But if price got there, and price reacted. Like right here, you can see that this high, because demand and supply zones are seated at highs and lows and sometimes in the middle of trends. This high right here holds the pin bar, but when price got to that pin bar, price did not show you no ability of slowing down. Price did not give you no bearish slowing down. Price kept on pushing to the upside. So it literally tells you that there's no way price is gonna stop. It kept on going to the upside. And you see we were in profit with more than $36. If you want to go back, we're in profit more than $36. At that area, the thing stopped. It took out the point, but you can see that we had more profit. Price gets there, price starts slowing down. It doesn't necessarily mean that when it's slowing down from the first couple of candlesticks, you should leave your trade. This is how trading is. Like I said, trading is a business. It's not only about buying, it's not like just selling, it's also understanding how do you want to move your money in your trades. Me personally, after catching a trade from this entry and it has played like that and it came down, if I caught a second entry off this level, it's pretty good because why? Off this level right here, it's probably a good price action as well. All these candlestick right here, because market consolidated, then broke out and gave nice rejections. Like candlesticks will tell you stories. You need to read those stories. Sometimes you can read all that story just on 1 hour without going on a lower time frame. Because why? All of this area right here holds support. All of these weeks is market changing structure on lower time frame. So market pushed the upside. These weeks are all pullbacks. It push and then it closes lower than it has ever gotten before at this area. This is an entry. This is a new stop loss right here. This is a new entry and a new stop loss and new risk management. Right there, second entry based off the movement, and you're still targeting as far as price wants to go. You're still targeting. Just like that. And in the middle of this trend, this doji, this is where the market gave you a continuation for a sell. The market gave you a drop, base drop. The market came back to that base and still dropped. You would have been able to catch again another entry when price closed lower on the lower time frame on this candlestick right here, because why? The market rejected. It literally kissed one time and then dropped. So that would have been another entry. You have had 3 entries of this trade because why? You're knowledgeable about what you're doing. You're knowledgeable about what you're doing. So in the factor where you've caught this type of trade here, again, you have a different risk management and you have a different exit point. Because why? You can't leave this type of trade to come and hit your stop loss. The moment you get into this trade, the moment this trade start playing around here, this should be the first trade you're closing. You're closing this entry because why? The manipulation right now is closer to your entry. So you're securing this first profit. You have your second entry right here, and then the very first entry at this point, which they are basically very close together. So there's not that much difference in entry, but there's difference in risk management because this is what it's like how many pips stop loss? What time am I using GU? Why is the stop loss looking like that? It's not showing like, let's say 75 because no, that's the amount of money. Why is the value weird? It's not showing in pips, it's showing percentage and then showing price level. It's not showing the pips. I'll just say it's like probably like 51 pips. That's a big stop loss. I don't think that's that 51 pips. Let me see. Oh yeah, it's like 49 pips. So that one holds a 49 pip SL, and this one holds a 94 pips SL. So based off your price action, based off your stop loss, that's how you have your lot size. You don't the days you have a smaller stop loss, the bigger your lot size to be, and the day you have a smaller you have a bigger stop loss, the smaller your lot size to be. Being there, you're still risking the same thing, the same amount of money, right? Because you don't just want to risk randomly. Because if you come this day and you're having a 96 pip stop loss, is this thing supposed to be really 96? I feel like something wrong here. That thing is a lot. I don't even know. I don't trade Drew like that, so I feel like that's a lot. But anyways, it's probably the right thing. I don't know. Probably is. Because that's so far. 49 pips is crazy. No, there's something wrong here. I ain't gonna lie. Because this thing is showing very differently. Let me see the settings. The values are kind of off to me personally. I don't know. Something is wrong. But anyways, extend left, extend right, templates level. it's whatever. But you guys get the memo. I'm not gonna get stuck on that right now, even though it's kind of like throwing me off. But you get the memo. So that is that about a supply and demand zone based off a doji stick candle pattern. So you see how you can identify those things before price gets there. Price has gotten there on this zone 1 and 2 times. So this zone has 2 touches already. This zone had 1 touch, but it was just able to push price just this little to the upside and then had the second touch. So that's why, like, right now you had this first rejection of here was a good ability for you to enter for a buy. It was good for you to enter for a buy. But now these are where you need to understand decision making in trading. You ask yourself, why did I leave this trade here at a buy and I didn't leave this trade here at a buy, right? Did any of you guys think about that? Like, why this is the first rejection of this zone? Why didn't you leave at this buy? But why did we leave at this buy? That basically the same thing. Right here, it's all about confidence. Both of them had good zones, but it's all on confidence level. It's all on confidence level and all on about what you're choosing to risk at this moment. Because somebody would have bitched out from this moment, this price candlestick had nice rejections and then came back again solid bullish, almost above that level, and then kept on pushing. But that person would be like, okay, if price now, this is where you start validating where you want to leave your trade. If price now goes above or close nicely within this level or above it, I'll leave my trade. Or maybe you could be like, I'll leave with 50% right now out of this trade. But if price continues to sell to the downside, I'll put back that 50% that I took out of that trade. Because overall, we're in a downtrend. So the market will have to make lower lows and lower highs. But the question is, do you know if this drop, the rally that's about to rally, is it about to rally back to your entry, or is it just about to rally to this next zone and then it continues to sell? So when it rallies back into that zone and creates back that, it respect that base and continues to sell, you put back that 30, that 50% of your entry that you cut out. Because now if you like, in this case, see how it came back down here and it respected that base and it rallied. Look how far, well, let's see how far price rallied to. And it broke past it. So you would have clapped your SL from here. You see that? You would have clapped your SL. So you see, trading is how you're deciding to move your money in and out. We all can take the same trade, but we all will not make the same amount of money. There's somebody that will hold the trade and just let it keep going to a certain point. There's someone that will take it in and out because they know how to exit and enter trades without no worries. So that is that on that part. So I'm not going to tell you there's too much of a reason why you should have left here for a buy and why you left here for a buy. No, it all came to the confidence level on that area, on what you were risking to keep, you were willing to keep risking. That's just all. That's all it came down to. Because all of them was the same knowledge. It was all the factor about the pin bar zone. It was also the factor of rejection and then potential reversal. But it was still overall on a downtrend. So it's about like the confidence level in things at the moment. So I'm not going to sit here and front you and be like, oh no, da 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 da. Nah. That's just how you want to choose to put your money in, and that's how you want to choose to take your money out. So that's the first pattern, which was a pin bar. I showed you guys a pretty good example. The next one, so this example was basically the market on a reversal level. So it was a rally-based drop. This was an example of a rally-based drop with the pin bar formation. The next pattern will be a bullish engulfing candlestick for your demand zone. We all should know what a bullish engulfing is. So you have a downtrend, you have a little bearish candlestick, and then now you have the preceding candlestick is bullish. So let me just change the color. Where can I change that color? That's too dark still. So what happens? You don't take, when you're drawing your demand zone, this is for demand zones only. Engulfing bullish candlestick is for demand zone only. So you don't take your zone or the bullish engulfing, no. You take your zone on the previous bearish candlestick body and wick. That's what you draw. So if market is doing downtrend, lower lows and lower highs, and it comes down like this and price goes up, comes back into it, then that's what you're expecting for market to do. Make sense? So this is a demand zone with a bullish engulfing candlestick. It's a downtrend. Demand zones are found at the bottom of a trend. Supply zones are found at the top of a trend. So vice versa, when you want to see a supply zone, it's what is it going to be? It's going to be a bullish candlestick, then a bearish engulfing candlestick. It's going to be a bearish engulfing candlestick. So you draw from what point to what point? You're taking in that bullish candlestick instead. That's how you find your supply. So price to what? The price is going on an uptrend, goes down. If it comes back there, then it drops. So this is off engulfings. Let's go on the chart and see if we can find any. For a bullish and a bearish engulfing candlestick. These are some good ones, but price is not respected, so there's no need to draw. That's why I tell you, price is not always respected, but if price gets there, then it's good. But in this case, price is not respected, so there's no need to draw those. You can identify it, but you need to wait till you see that proper respecting price. This is one. This is another one, but this one was respected. This one was not respected. So let's take a look at how it was respected. Did I just lose that shit? I think I did. Freaking hell. Why am I doing this on a weekly time frame? I think that's why it's kind of like bugging. Let's go to 1 hour. I literally found something and I lost it. That's crazy. All right, this is an example right here. So this is an example of a bullish engulfing. So price dropped, price got there, came back to the zone the very first time. The very first touch was not the strongest touch, but it did buy up. Came back again the second time, and that touch was a strong touch. So it bought up, and then look at how high price went. And this is a 4 hour demand zone. Price came the first time was a weak push up, came back the second time was a strong push up, and it just kept on going, and see how high price pushed it. And this zone has had only 2 touches, so I'm still having that zone right there. So this is the demand zone, bullish engulfing right there, factors of you entering your trade. But this is a 4 hour time frame zone. So you have to go down on you could decide to play it off on the 4 hour time frame, but me, I'll go down the lower time frame and I'll look for an entry, because that's probably what I did. I didn't probably wait for an entire 4 hour candlestick to close. I went down on lower time frame and I probably cut it from there. Yeah. So the moment we had that first rejection of it, like you can see, even the 1 hour time frame has the supplies, the demand zone right there. Like you can see it. If I want to even draw it off this one as well, this is the demand zone right there, based off the bearish candlestick, then the bullish. Price got there very first time, kissed it off news. This was even like where's the week right there? right there. All right. So he came there, he had the first touch, second touch. I took it off this level right there. He pushed up, did whatever I did, he rejected off this level right there, sold back into the area. I didn't bother myself, came back again, and then he gave me a nice bullish price action. I just drew this, but I probably took this trade because this is where I probably take the entry from and stop loss below there. So that's why I probably took this trade from. I think I called one of these trade one day. I don't remember. I probably called this trade. And then from that point, that was it. So when it gets there and it validates structure and it gives you the entry, that's great. Like you can see right here, it's another pin bar. This is the pin bar formation. This is the pin bar formation for a potential demand zone. This was like a doji. Dojis too are also used. I use dojis as well. The pin bars are always the best. They kind of like stronger. Price got there. Let's just say our price got there and price did not give me, price did not give me what I wanted to see. Like price did not give no bullish price action. So there was no reason for me to enter for a buy. But if price would have closed bullish above this candlestick, I would have entered for a buy. So that's what I'm saying. After seeing the zone, identify the zone, you have to wait for bullish or bearish price action before you enter the trade. You didn't just enter because you were able to identify that zone. It means it's going to respect that zone. No, you have to wait, guys, just like that. Oh no, this thing is not giving me a lot of bullish engulfings and bearish engulfing demand and supply zones. I'm not seeing a lot of them. But you guys get the idea, right? You get the idea, you get the speed of it. What's that thing? All right, this is still another one for the bearish, then bullish engulfing. I drew it up there. It's just because I changed my charts, but you can see that I have a zone around this area. I changed the color of my chart so some of the things don't show nicely. Let's say that's the color right there. Price came there, bullish engulfing, right? Entry, stop loss there, and see how price went up. See how price just went up right there. Message only mantra. That was that shit. Okay. Right there. And see how far price went. See. And we had a zone here. This is a zone right here. That price has respected that zone before for a sell. But in this case, when price got to that zone, price did not slow down or no proper bearish price action. Price broke past that zone. So that zone became invalid zone. See how this is a zone right here that I drew even before price got there and it respected it and I'll be able to take a short. But I didn't. I probably didn't see that trade. You can't see everything. You see things now and then, not everything. So I've given you guys a lot of example on the bullish price action, but I haven't seen a lot on the bearish. Sorry, on the bearish for the sell side, but I've seen a lot on the bullish. But that's still like, just like switch up your brains. Okay, this is another one. This is the bearish case right here. You have bearish price action. This is the zone. Let me change the color. Like I said, when price breaks past that zone is invalid. You don't even need it no more. I just be lazy to delete some of these things off my chart. Oh God. Price gets there the first time and see how it sold. It rejected and then sold down. Manipulated, did all what it did, came back into this previous demand zone, reacted up that demand zone. See the demand zone, first touch reacted. So this is the first touch and this is the second touch. So it's not all the times that you want to like just take it to see how this one came here, it broke. So imagine you're just trying to enter a buy because price respected the first time, second time, Matt really said it's supposed to respect at least like 3 times, 4 times before you're being scared. No, every time it gets, even if it's the very first time, you just have to still wait on proper price action to validate that trade. So it don't matter if it's the first or last time, you gotta wait. So it's all the practical examples making sense to you guys, how you identify your demand and supply zone based off bullish and bearish engulfings. Does that make sense to you guys? And how to validate them before entering the trade? Because you find the areas but you have to wait. Like this is a bullish engulfing right here. You find this area, the price got there, price did not give you any reason for you to want to buy off that level, so you don't buy. If it's making sense, drop a one in the chart. All right, bet. All right, that's that for bullish engulfings and bearish engulfings. The next thing is inside bars. This thing is not letting me like this chart. We're looking at inside bar patterns. Inside bar patterns, I should have like a picture. If you guys, this thing. Yeah, an inside bar pattern. This is bearish engulfing, bullish engulfing, whatever this. Let me look for inside bar pattern. I only got to see like the example, but I don't know if this thing has it. I'm trying to look. It's inside bar. It's a 2 candlestick pattern. So if you want to take a screenshot of this, you can take a screenshot of this because you will need this. This is all those tell you indecisions, moments of seeing these decisions. You know what candlesticks are indecisions and what candlesticks are decision candlesticks when the market has decided where it wants to go to. But an inside bar candlestick is basically like the reverse of a bullish and bearish engulfing. So basically you have a bearish candlestick, then you have a bullish candlestick. So this is a bearish inside bar. So this is going to be a bullish candlestick instead. And then the same way you want to draw it, you're drawing it based off this level. You're drawing based off that. So the market could be like on the bearish momentum, and then it could create that and then it comes back. So it's like this is supply zone, and then bullish inside bar is vice versa. And this one is going to be a demand. So vice versa as well. Those type of things. So that's how you have the inside bar pattern to draw your demand and supply zones. Let's go on the chart and see if we can find any right now. Let me change this. This is audio Wednesday. This is bullish inside, bullish engulfing. If you guys let me see, if you guys see anyone, let me know, because sometimes I'm just hoping to see based off ones that I've seen in the past. See that. This is an inside bar, a bearish inside bar, but this one was not respected. So I can't use that. This is a pin bar. This was respected multiple times, then finally dropped. But we're not there for pin bars. But one thing you find is that you mostly see pin bars. So this is this is one right here. This is a bearish inside bar. So you see that supply zone right there. So the very first time price came, it didn't sell as you wanted it to have sold. Came back again into that area. Then you see how it just dumped from there. And then it finally came and broke it. So that's a inside bar right there for a bearish confirmation for a supply level. And sometimes like these consolidation. Consolidations are also demand and supply zones. That's one thing. I call it the build up. So when it like consolidates like that, this area, you just draw all of it, and then that's your demand zone around that area. So this is a build up. I call it the build up. This is a bullish inside bar, but this zone was not respected, so we're not gonna worry about that. This is a doji, I mean a pin bar. So you see a pin bar. Mostly you always see pin bars. You always gonna see majority pin bars. This is bullish engulfing, bearish candlestick. So that zone was respected. You can see this right here. It's a nice zone. So you can see that this candlestick wicked into this area, but it closed as a wick. So this zone is still very much valid. But you go on lower time frame and you realize that these were a couple of candlesticks. But now, if it's candlesticks that is there, it don't matter. Like on the 1 minute time frame, you see that it's a 1 minute. Why is this thing not going? Oh, you cannot go to 1 minute time frame on playback. Excuse me, but on 1 minute, this is a candlestick. It's just the replay will not let me go that lower time frame. So that's what I was telling you guys. On the one, if you validate, you draw from the 1 hour, then you're validating from the 1 hour. You don't validate off a lower time frame. Price got there, reacted, and then the multiple times price was playing there. You could see that you drew your zone the very first time. You see how price is gonna get there. You just draw it and leave it there. You don't even, it could come back any day, it could come back next month, but you just have that zone there and it's waiting for whenever price gets there, and then you take your trade off it. Like this was the first touch when it wicked out of here, and then it pushed up high. So it's telling you that's a strong zone. That's when this is probably news reacted of that zone. So that's a good zone. You have multiple zones on lower area, which is one of them is also an inside bar. This is the bullish inside bar right here. This is a bullish inside bar right here. You can see it's a bearish engulfing, then a small bullish candlestick. So that is your another level of demand. So you have multiple demands. So price could break one demand and you're just waiting on it on the next demand. So don't be like, oh, why am I seeing too many demands? Just look for the best lows and highs of the trade, and then that's where you want to take your trade off from. You can see all this little consolidation right here is called the build-up. So that is a supply zone. Price came there and it rejected 3 times and it was a good sell. That's the build-up. There's just one candlestick pattern that I honestly would not teach you guys today. I don't ever think I'll teach you guys, I ain't gonna lie. That's like a secret peep hunters pattern for like the paid students. But I've given you guys a very fair amount of knowledge today that honestly, if you go back and you identify these things, you should know how to do things. You should know how to like trade well using this. So that was the area right there. Price came multiple times, the first time and then the second time. The first time, look at that. Nice morning star. This is what I call bullish price action. This is the morning star, it's a bullish price action. It gets there, and then what you have to see, price goes to the upside, to the very high level, breaks out so many highs, and it just kept on going up. Price comes back again, entry above right here, and it keeps on going up till it finally reversed on there. So that is for that on an inside a bullish no, that's a bearish inside bar. Yeah, sorry, a bullish inside bar. Sorry, it's a bullish candlestick, then it's a bearish, then a bullish candlestick. Like I said, the other ones is a doji candlestick as well to use and draw your demand and supply zones. Basically, dojis, you want to take it at the high and at the bottom of the pattern, and as well when it comes to the consolidations, the build-ups, because like if you see a practical example of a drop-based drop, is price literally dropping, then it like consolidates, then price goes and come back into that base, which is that, and then it continue dropping. So it's a drop based drop, rally based rally. You see price rallying, comes back. I mean, it consolidates, comes back, and then it goes because why this was a base right here. So that's what you want to see, those type of things. So those are the couple of patterns that you're looking forward to. So demand and supply is drawn of candlestick patterns. So it's not drawn off areas of majority of rejection or whatever. No, you want to see rejections. So whenever you find out your trade, if you go on 4-hour time frame, you could draw a forward demand and supply zone. It's validated based on the 4-hour time frame. This is a whole engulfing, nice rejection, sold, but it didn't sell all the way down, push back up, and from there it's sold because why? You can see that on the forward time frame, it didn't close, like the candlesticks did not close crazy above that area. Just like see how it still came back and rejected within that area. So that zone is still valid on the forward time frame. And as everything, lows and highs are holding orders. So when you're in a trade, your ideal is that you want to see the market take out that first high, keeps going. If it pulls back, it takes out a second high, it keeps going. That's how you want to see it because these highs are holding orders. Those highs are holding supply and demand. I mean, they're holding supply. So if it's breaking those highs, you want to keep holding your trade. And as well as prices breaking those lows, you want to keep holding your trade. So that is that on that. So I don't think it's anything else on demand and supply. Now it's just for you guys to go on the charts and just practice what I told you today because you will you see a lot of trades based off it. Like the trades I called this week for my students. I didn't call no trades. Did I call any trades this week for the free people? I think I called AJ, right? I called AJ short. I did a whole video this week. So anybody that watch this video should have benefited. But some people don't watch it. People be lazy, but that's nothing to do with me. I don't care. If you want to be lazy, you want to be broke, that's on you. None of my personal problem. I do my part, you do your part. So this was like I said, I called the AJ. I'm trying to look for that AJ. Trying to look for that AJ short. This week started on the 20th. Yeah, the first trade I called was UC short for my people. I was like looking at UC short. I said no proper bearish price action, so no entry. We had our area, we had our doji area right there. It was still like the whole build up. I could have joined this supply zone based off the entire build up or just based off this. I see this zone right here. I do it based off what this pin bar. So that was one entry right there. The second trade, this was the pullback into this area. So this was a whole different entry. I already taken money off the table of this one. This was a new entry. I was like, I'm looking for it to sell down. Let's see if price did that. Price did what it did. I had my entry with a 9 lot. And I was like, okay, I want to see price use the gambler as the base for me to put another entry. So gambler is like a whole type of candlestick that basically I named it that way. So yeah, it's much like my candlestick. I have ownership to that candlestick for that name. So based off, you see, this is an inside bar candlestick. I'm in a bearish engulfing. You could draw that zone. Nice proper rejection. Price came in there, gave a nice proper bearish price action. It went lower than these weeks. And that's why I called that entry right there because it gave me a pullback within this area and I got in. Started selling, but it was like a little bit choppy. But now this is why I say it's all about confidence. This was a rejection area right here because why? This was an inside bar. So I was looking for that if price rejects of the inside bar, how far do I want to keep holding this trade? But when price now respected this newfound supply zone here and it didn't go above it, then I like, yeah, because this trade, if it was going strongly bullish, I would have left that break even. So it's a risk-free trade. So that's why I say sometimes trading is all about confidence. I would have left and like I'll be scared. When the trade kept on selling and I made money. Waiting on the candle to close solid bearish for me to get an entry on AJ. AJ, that's the build up right there again with the consolidation. So that was a supply zone. This was the first supply zone price respected it nicely, but I didn't take a trade off this level. I took a trade off this level for the pullback. And what happened? Well, AJ kept on selling and he gave the money. I don't know. I don't think I even sent an after picture, but it was something different. I probably said it during the class I had with them. And one of the people, they passed their fundings again. 6-figure funding, as always. Like my people don't be playing, they be getting that back. So that's that, guys. I don't really have anything else on this topic. Is there any questions so far on how far we've come in today? That's a document. Did everything sinking, guys? It was sinking more when you go on the charts. Yeah. Right now, you can just only do the most of that. But yeah. You post a record on your YouTube, I'm gonna be there. I haven't posted a recording on YouTube since the last month. I've not done that. I don't know why. I'm lazy, ain't gonna lie. I haven't posted it on my YouTube though. Yeah, so this is a whole new theory. You guys just go on charts, see how you can identify, make sure rule one, and look at your price action, look at the candlestick pattern. Rule two, wait till price gets there and wait for price action to happen, then you get your entry. And that's about it. Like this one would have been like, oh, I want to draw a zone here, but price did not respect this zone, price broke past it, so that's an invalid zone. So it probably would have deleted it and life continues. Price got back into this build up right here, this consolidation, which is the build up, and then it dumped. This was the first rejection for a sell, which was of this bearish engulfing. So you can see draw a bearish engulfing, price gets there, it gives you a whole like an evening star entry, stop loss above here, go all the way down, sweet ass entry. Like this thing, so it's miracle, some miracle type of stuff. You realize that. I don't even worry about it. Trust me, no matter what academy you join, they will not teach you this type of demand and supply. I should know. I've been in a few in my life, and they never taught it like this. This when the market open up, I'll see if I can find any new setups. Then I'll drop, make a video. So you guys should be watching those videos. They are better than just than just having that the setup sent. At least I'll tell you why I took a trade, why I left a trade, all that type of stuff. It's like a little bit more educational videos for you guys with the breakdown. So those should be helping rather than just dropping, because I don't like I'm not a big texter. I don't like to write, oh, I'm looking for this because of this. No, I'm just gonna drop that video, little breakdown, and you just like you follow up from there. Uh but the market's about to open, or it probably already did. Yeah, it probably already did. It capped down. And I'll do my analysis later on. I don't like doing the analysis immediately as the market opens, but you can see that these I've been drawing the zones, the areas I want to see price reject. Price is literally on an uptrend right now. It's about to take out this first high. I think if it takes out the first high and if it keeps on pushing up, I want to see a little build up around this area, probably like a change of structure. Then I'll enter to short. Excuse me. But if not, then that's fine. But this is a strong area right here that price has been respecting before, a 4 hour level of um of supply based on this candlestick pattern. So see the market dropped, it gave you a bearish engulfing, and then first rejection, second rejection, third rejection. So if the market comes back to a fourth rejection, this is a strong area because every time market rejected up there, it was strong as pushes. So the higher the time frame, the stronger the zone is gonna be because like it's a longer distance. But now the thing is it's all about the entries. You have to go down lower time frames and double of those entries. So when you have, that's why you always need to start your analysis on a top-down analysis basis. You start from higher time frame to lower time frame. Lower time frames for entries, higher time frames for direction and bias of the market. So if you don't know what the market is happening from the hour and above, you should not be playing around the 30 minutes time frame. That's an entire waste of your time. So this one is a whole zone that has been broken, so I can just delete it. On higher time frames, I really don't draw the zones because it will make too much messy work. I just draw lines on the area of the candlestick. But yeah, I could just draw a line and I know this is a 4-hour level of demand. So if I see price coming to this demand, I would want to take a buy off there. So that's just all I'll do. Just like keep your charts clean, not too cluttered. Just like that. This one is a daily, actually. It's a daily. I'm on the daily time frame. So the 4-hour, this is 4-hour level right here. First touch was a strong push up. This one came to, and we're just gonna see how it's gonna play all around here. Then this is the 4-hour level of demand based off this doji candlestick pattern. But on the 4-hour level, on the daily level of demand, this is the opening right here. This is where the zone starts. But on the 4-hour, this is where the zone starts. So I can either take a buy when it rejects off here or it rejects off here. So it just depends. But it depends how it plays around here too for me to want to take a sell. So trading is just, you see A, B, do C. If you see whatever I want to see, you do the next thing. You just have to wait for it to form itself. Then you enter the trade. If it doesn't form itself, then you don't enter the trade. It's just that simple. You create rules and follow the rules for your entries. Let me stop recording because that's a lot talking right now.